These are my note cards. I'm Andrew Gehrig, and I'm here to talk to you about what happened after the financial crisis and central bank policy since then. But to really understand it, we have to go back to 2007 in order to understand the central bank policy. The 2008 crisis began in actually 2007 with the collapse of the real estate bubble. Housing was the biggest thing in ever since from 2004 all the way up to 2007. People were buying condos, houses, and even just regular land hand over fist. For example, condos were going, someone would buy it actually before the condo was built, say for $100,000, and then sell it after the condo was actually built and double their money without ever even setting foot or having the intention to live inside the place. And that was just what it was like during the real estate bubble. When this bubble finally burst, it spilled over into other things. It spilled over into the finance world, where mortgage-backed securities, which is just bundled and packages mortgages, like on your house, almost everyone has a mortgage, and they package them together in certain grades and then resell them to investors, pension funds, all sorts of different things. But when the underlying asset, which was the house, collapsed and people defaulted, then there was just a complete collapse in the financial markets, because if the underlying security doesn't have any value anymore, all the derivatives don't have any value either. And we'll get back to derivatives later. So the Great Recession, it causes this huge collapse, and some financial analysts have said that if they didn't act soon enough, within a couple more hours, there would have been complete destruction of the financial markets and a complete global collapse, which is pretty scary to think about. But now we're going to go and talk about what the Fed did after 2008. So the Federal Reserve, the United States Central Bank, was headed by three chairmen, which helped see before the crisis, one during the crisis, and one is in office now after the crisis. These chairmen have been first starting with Alan Greenspan. He took in office in 1987 and stayed until 2006. Then there was Ben Bernanke, and he stayed in office until Janet Yellen replaced him. And Janet Yellen was one of the first female Fed chairwoman in this case. So the Federal Reserve, the nation's central bank, their job is to control the currency, to provide price stability, and maximize employment. Now, preventing deflation was their number one concern after 2008. As we talked about earlier, there was this big collapse in the mortgage-backed security market, MBSs, and other sorts of securities linked to housing. And the Fed had to stem that, because if they didn't, it'd spill over into the next thing, which spilled over into the stock market. Then from the stock market, it'd go into people's personal portfolios, which it did. And then from there, it goes on to employers and producers. And if producers aren't making as much money as they normally would, say a factory gets only half the orders that it normally does, it's going to have to scale back. And what it scales back on is its production. And part of its production cost is its workers. So they fire some workers. Now it doesn't seem like a big thing. They fire 10, 15 workers. But if factories across the United States are doing that, it leads to a larger and larger effect. Then it snowballs, and then it goes into the next step. This next step is where the people that have been fired or laid off, they don't have an income anymore. So they stop buying, and then it goes back to the producer again. The producer has to cut more. You can see it's just a downward spiral, and they don't really know where it stops. It obviously has to stop someplace. We don't go back to the caveman times, but it can be very detrimental. So that was the Federal Reserve's number one issue that they wanted to prevent. Number two is they want to stabilize employment, which goes along with deflation, but stabilizing employment means that they want the target to be in around 4 to 5% unemployment. Ideally, they want to have 100% full employment, but it's not possible. It's a theory that really can't be reached. Low interest rates. and quantitative easing were another very big portion of the central bank's policy after 2008. They started quantitative easing. Not only quantitative easing, but they came up with a sequel and then a sequel to that sequel, and even something in between. They had quantitative easing 1, and that was just the initial bond buying purchases. And what they do is they take mortgage-backed securities from banks, the troubled banks, the lending institutions that held them, and they purchase them from them. And then in exchange, they pay them obviously U.S. dollars, and the U.S. dollars go into deposit at the Federal Reserve in the bank's accounts. The banks could then take this money and then use it and loan it out or do whatever other operation they wanted to do with it, but most of them chose to keep it in their accounts. We'll get back to that later. But this bond buying program had an effect of lowering interest rates. If you just think about the bond market, it's people trying to get money up front, and then they'll pay them interest over a period of time, and then at the end they finally pay them the principal back. Well, if there's a big buyer in the market like the Fed who's scooping up billions and billions of bonds, billions and billions of dollars of bonds per month, then you can see how interest rates are going to drop, because there's so much demand for bonds and the supply is pretty much the same, so the interest rate's going to drop. And as the interest rate dropped, it leads to a bunch of other types of easing in the U.S. economy. Right now you can go and get a home for 3 to 5% APR for 30 years and lock it in, which is historically very, very low. These excess reserves now, we'll get back to those. Excess reserves, we'll just start by breaking down what required reserves are. Required reserves are deposits that banks have to keep at the Federal Reserve, and it's just your deposited money that they have to keep there, and in case for like the FDIC insurance that they have, if there's a banking collapse or some fluke virus wipes out your money in your bank accounts, the Fed has some money to give out and resupply and provide liquidity for the U.S. economy. So this required reserve ratio is around 10%, and beyond that is what's called the excess reserves. So if banks put in more than that 10% required reserve amount, then they'd be in the excess reserve territory. Right now, we're at, according to the Federal Reserve's website, this is the Federal Reserve Bank of St. Louis, we have $2.5 trillion sitting in excess reserves. And you have to understand that this $2.5 trillion, by the way, that's more than half of one U.S. budget. 2015, the budget's $3.9 trillion. This money's just sitting there, and it could be loaned out in the future by the banks, and when they loan it out, it creates what's known as a money multiplying effect, where this initial amount's loaned and then it's deposited at a bank, and the bank can re-loan out that money, and they can really stretch this money and make it 10 times as big if the reserve requirement is 10%. So as you can see, the money multiplier can play a big role in the U.S. economy and its recovery. That was what the Federal Reserve was hoping for by stimulating an asset bubble in housing and then the stock market. So the Fed carried on this quantitative easing program, 1, 2, and 3. Then what I said was the middle thing was Operation Twist, which doesn't get a lot of note, but it existed. The latest QE, QE3, comprised of buying $85 billion of bonds per month, and the Federal Reserve would take these bonds, as we said before, and they put them on their balance sheet in exchange for dollars that the banks would keep. QE3 ended in October 2014. They wrapped it up by doing what's known as a taper, where they just took off $10 billion a month until they got down to $15 billion, then they wrapped up the whole program. So start at 85, go to 75, so on and so forth. And that taper is supposed to just help ease the economy back into a normal, healthy economy. So after QE ended, the next step into becoming a healthy economy once again, because normally this scenario isn't normal. Central banks just don't hand out money in exchange for bonds all the time. This is supposed to be just an emergency measure, but it was kept up for years and years. So the next step would be raising interest rates. Interest rates are dependent on bond buying, but the Federal Reserve also has some tools that they can play with to keep interest rates low. The Fed has to raise interest rates at some point. They can't stay at 0% forever. It punishes savers at the expense of people who are highly in debt. But actually, it doesn't really help the people who are highly in debt, because if you're thinking about credit cards, credit card rates are still 15 to 25%. This is a little bit of a side note, but when you think about it, if the credit institution only has to pay 1% for the money, or even 2% for the money, and then can lend it to you, and you have to pay them back 24% a year, that's almost extortion. So now, if we get into them raising rates, Janet Yellen and the FOMC, which is the Federal Open Market Committee, they have a decision when to raise rates, and if they raise them gradually, just a few basis points, and a basis point, all that is just 1/100 of a percent. So if you say 10 basis points, that's 0.1%. So if they raise them a few basis points at a time, 25 basis points, 50 basis points, then it will be very gradual. Or if they're gonna just shock the world and just go up to 5% interest rate or a 10% interest rate, then that's highly unlikely in many analysts' opinion, but it could still happen. So the Federal Reserve is faced with that. One thing is, how much do they want to raise rates by? And the second is, when are they going to do it? Some analysts they speculate that they'll raise rates in May or June. And the Federal Reserve releases a statement 4 times a year, once every quarter, and in that statement they give the state of the U.S. economy, they give their projections, inflation, and they use a special inflation index. They don't use CPI, they use PMI, I think it is. And then they also just give the general outlook for the U.S. economy and the global economy. And then from that, they're supposed to make their decisions. So the Federal Reserve, in their fall press statement, they said that they were going to raise rates in considerable time after they closed the program. Considerable time, people took it as meaning 6 months, a year. The estimates varied. Some people even thought it was just going to be like 2 months, but considerable time was erased out of that report in the winter, the December statement, and replaced with that the Federal Reserve will have patience going forward. Now that's very vague too. It doesn't give you a really good idea of when they're going to raise rates. And some people are speculating it could be as early as May or June with good economic numbers. Now here's where the road really diverges, and I have to give you both sides of it. There's one group of people on Wall Street and the analysts throughout the world who think that the Fed is going to raise rates soon, whether it be May or June. And then there's the other portion that think that the Fed's going to wait maybe till the fall or later in the year, maybe even 2016, to raise rates. And then there's a really small portion who say the Fed's not going to raise rates at all because they can't. We'll just cover all those really briefly. So the first group, the one that thinks that the Fed's going to raise rates in May or June, for them, the U.S. economy and the numbers that we've been getting back have been great. Unemployment right now, it's actually, the official number is that it's at 5.6%, which is the lowest it's been in almost over a decade. Producer numbers are up, consumer sentiment, people are feeling good, minimum wage is rising, and the economy has done much better. After all, look at the stock market. The Dow is up past 18,000. The S&P 500, it just hit a record high yesterday. And the Nasdaq's up very well too. They've been the Dow peaked at 14,000 before the crisis, and then dropped down to 8,000. Now it's back up to 18, so it's 4,000 higher than it was before the crisis. So that shows we're far out of the crisis, and we've gone on from there, and we're going to continue to keep going. And these are the bullish people in the market, and those who think that the U.S. economy is the best economy in the world right now. And it may very well be because places like Europe are doing quantitative easing, China's thinking about doing easing. So a lot of countries are doing what's called debasing their currencies. Now we get to those middle of the road people who are wishy-washy, and they think the Fed's going to raise rates late 2015, early 2016 because there's been some turmoil now. Things like the Ukrainian crisis, ISIS, there's all sorts of things that just pop up and might keep the U.S. economy off balance. The numbers aren't quite good enough for them to raise in May, but they're getting better, so that way they can raise them the later half of the year, but they're going to raise them sometime because they have to. This low interest rate environment just isn't good enough. It doesn't work, especially for investors. They have to take huge risks on their money, so they have to raise them in eventually, but not right away. The last group of people are the rare, the far and few in between. They don't think the Fed's going to raise rates at all, or if they do, it's going to be detrimental to the U.S. economy. These people are Jim Rickards, Peter Schiff. The list goes on a little bit. It's a small list, but it goes on. And they think that Wall Street's really overvalued right now, and that the underlying economy is very weak. They cite that consumer confidence is very low right now. They say they claim that wage growth hasn't been there, when what the other group is saying that we've had a lot of wage growth since 2008. You can be the judge of that and what you see in your personal life. Have your wages gone up since 2008? Some say yes, some say no. It depends where you work. Maybe if you're a stockbroker, in these guys' opinions, Peter Schiff, if you're a stockbroker, maybe your wage has gone up a lot. But if you're just working a normal job, maybe it didn't. I can't really give you my honest opinion here, because this is just an informative speech. But you be the judge of it. And they also cite that we've seen massive deflation in the oil markets. How can you raise rates, which causes deflation because the dollar is stronger? And when you have a stronger dollar, that means prices are going to fall. And so if you had a weaker dollar, prices are going to rise. The government usually likes rising prices because the dollar is weaker. They can pay back their debts. And right now our debt has hit over $18 trillion, our national debt. And it's easier to pay it back when interest rates are low and inflation is high, or one of the two. So people who are looking, Peter Schiff and James Rickards, who are looking at the fundamentals of the economy, they say that the Fed's not going to raise rates at all, and that they're actually going to do QE4 and have a larger bond buying purchasing program than ever before. I have a couple of books from James Rickards and Peter Schiff. This is Peter Schiff's Crash Proof 2.0. This was released in 2007, and he outlined the financial crisis before it actually happened. Here is James Rickards' book, Currency Wars. He also has another book, The Death of Money, and in those he explains the coming global financial crisis, as well as the past global financial crisis, and what's known as currency wars, where countries are competing to debase their currency to get ahead on their debt. Both really good books. You should read them if you get a chance. Also read some other people's books to get an unbiased opinion. You can read people's books. A columnist for the New York Times, his name's starting to elude me now, of course. You can read Ben Bernanke's book, Janet Yellen, I think she has a book, and there's a bunch of other people out there that you should really start listening to if you want to know more. So just to sum everything up, because there's a lot there, and I could talk for 20 minutes, a half an hour maybe, even about this stuff. There's people who do a podcast once a week, still talking about stuff from 2008. And if I'm just going to summarize it, the Federal Reserve had to do something after 2008. Otherwise, we were going to be in a global financial crisis that was far, far worse than it actually was, and we would have been talking complete collapse. They had to do QE to stimulate the U.S. economy again, to get asset prices up, and to hopefully start a recovery. And then that caused the interest rate to drop. This was historic because interest rates have been so low for so long. This also has possible bad effects. With low interest rates, people are looking for riskier investments so that way they can get a high interest rate. And there's a possibility of another financial crisis because of that, but it's not guaranteed. Then there's also the divergence between whether the Fed's going to raise rates in June and May, or if the Fed's going to raise rates in December or early 2016, or if the Fed's not going to raise rates at all. So thanks for listening to my speech, and I hope I could inform you a little bit more on central bank policy. It's a complex world, but you learn more each day.